On that issue of payment for order flow, we've had Ken Griffin on the program, we've had Vlad Tenev from Robinhood on the program, and so many others who've made an argument that because of the lot sizes for retail and the like, that they're actually getting better pricing, is the argument they say, for their customers. And so that they're saying it's not costing the end user. Do you believe that?
Well, there's evidence that shows that there's a conflict. We had a case settled in December of last year where the wholesaler in that circumstance actually had written to the broker and said, there's a trade-off. We could give you more payment for order flow, or we could give you better execution for the customers. A clear sort of trade-off. And there are brokers that don't take payment for order flow. And as I noted yesterday, the United Kingdom, Canada has banned it. So we're going to take a close look as to how the market structure can work best, be most efficient, and protect investors.
But in your mind, though, do you see a solution being the issue of more disclosure, meaning as long as the customer knows this is the arrangement, it's okay? Or do you think the possibility of banning it is real and that might be a better solution?
So, Andrew, we're still at early stages. I'm in third week in this new job, and I'm so privileged and honored to be in this job that President Biden asked me to do it and the Senate confirmed. So I want to hold off on that, but I would say this: disclosure alone may not do it. And there's times where there's an inherent conflict, and then thinking about what the market structure can be to be best for investors, but also for issuers. See, if we have concentration in the middle of our capital markets, concentration tends to lead to higher prices and more fragility. And that means even issuers accessing the markets know that there's a gatekeeper or an individual in that middle that can extract what's called economic rents.
Chair, you made a point yesterday that Citadel Securities has publicly stated that they effectively execute about 47% of all trades. Is that too much? And to the extent it is, or it's something you're concerned about, what kind of solution do you see?
Well, again, we're still working on it, but I'll share something else. If you or I put a market order in, again, I don't any longer because I'm the chair of the SEC, but beforehand, put a market order in on a retail platform, the vast majority, well over 90% of those go to these wholesalers. It doesn't go to the lit markets like the New York Stock Exchange or the NASDAQ or in Options World, Chicago Board, and so forth. A lot of these are really just going to the wholesalers, and they're not as lit, they're not as competitive. So it's not clear that we're actually getting best execution in an unlit, internalized wholesaler as contrasted to the lit markets.